All right, today we are diving deep into the international shipping company SFL Corporation. Now, this is a stock that a lot of income investors absolutely love, and for one very, very big reason. But the question is that huge dividend a sign of a fantastic investment, or is it a warning that this ship is about to run into some trouble? Well, let's find out. And there you have it. That's the number that gets everybody's attention. A dividend yield of over 9%. I mean, for anyone looking to build some passive income in their portfolio, a payout that high is, incredibly tempting. But that brings us right to the heart of the matter, doesn't it? Is this massive dividend a sign of a truly great, undervalued opportunity, or is it a warning sign? A classic value trap that's hiding some really serious risks under the surface. That is exactly what we are here to figure out today. Okay. First things first, to really get a handle on the risks and the potential rewards here, we have to look under the hood at the business model itself. To see how SFL actually makes its money, you gotta understand that it's not really a typical shipping company. So think of SFL less like a shipping operator and more like a landlord for the high seas. It's a great way to think about it. They own this huge, diverse fleet. We're talking container ships, tankers, offshore rigs, the whole shebang, and they just lease them out on these long-term contracts. So what does that mean? It means they collect a steady rent or charter income instead of having to deal with the wild day-to-day price swings of global shipping. And this really gets to the core tension in SFL's entire model. See, on one hand, you've got the stability of those long-term contracts, which gives them a nice, predictable stream of cash. But on the other hand, the whole business operates in the shipping industry, which is famously volatile and cyclical. It's like this constant tug-of-war between predictability and chaos. Okay, so with that business model in mind, let's dive into the numbers. We need to see if the company's financials are strong enough to actually weather those storms when they inevitably show up. And what we find is, well, it's a story of some very conflicting signals. So, on the surface, things look pretty good. A 12% compound annual growth rate for revenue over the last 5 years. That's strong. It shows the company's been expanding and bringing more money in the door. But as you know, revenue is only one piece of the puzzle. And here's the catch. The return that SFL gets on all the capital it plows back into the business, all those incredibly expensive ships and rigs, is less than 6%. Now, for what we'd consider a quality business, our analysis looks for a target of at least 9%. This low return, it kind of suggests the company isn't creating a whole lot of value from its investments, and that's a pretty big red flag for long-term growth. Now, here is where the story gets a bit concerning. This low profitability is combined with what our analysis points to as the company's single biggest weakness, a fragile balance sheet. Man, this company is carrying a heavy load of debt. We're talking about $2.6 billion. You can see the high debt-to-equity ratio, and that weak current ratio means they don't have a lot of liquid assets on hand to cover their short-term bills. Now, in a really stable industry, that might be manageable. But in the unpredictable world of shipping, this kind of debt can dramatically, and I mean dramatically, amplify the risk if a downturn hits. And you can see that risk right here in the cash flow. In the last year, things looked okay with $124 million in free cash flow, but notice that's already less than the $133 million they paid out in dividends. And if you zoom out and look at the 5-year average, free cash flow has actually been negative. That tells us that juicy dividend isn't always being covered by the cash the business is actually generating. That's a big deal. So let's shift gears and talk valuation. How does all of this, the good and the bad, translate into an actual price for the stock? What is SFL really worth? Before we get to the numbers, it's really important to remember what we're looking for here. Intrinsic value isn't just today's stock price on the screen. It's our best estimate of the company's fundamental worth based on all the cash it's expected to generate in the future. So, to get a really solid estimate, the analysis uses 2 different valuation methods, a discounted cash flow model and a multiple of earnings model. By blending those 2 together, we land on a more balanced result, a calculated intrinsic value of $9.68 per share. So how does that $9.68 stack up against the market price? Well, this chart makes it crystal clear. With the stock trading around $11, the market is pricing SFL at a 14% premium to its calculated value. In other words, according to this analysis, it's currently overvalued. So let's put it all together. With all this info, the business model, the financial risks, the valuation, what is the final verdict?
What's the actionable plan for a long-term investor looking at this thing?
A weighted analysis of the company's strengths, weaknesses, opportunities, and threats, it gives us a net score that's actually slightly negative. And the key thing to see here is that the major weaknesses, that's the high debt, the low returns, and the cyclical nature of the business, they just carry the most weight. They end up overshadowing the strengths, like that big dividend. And if we look at a few potential futures, we see our base case value is that familiar $9.70. For the stock to actually be worth today's price, above $11, you'd have to believe in a pretty optimistic bull case scenario where growth really takes off. And that suggests the current price already has a lot of good news baked into it, leaving you with very little margin for safety if things don't go perfectly. Now, this brings us to a really crucial piece of actionable information for any potential investor. This table here shows you what price you'd need to buy the stock at today to hit a specific annual return. So if your personal goal is a 9% annual return, which is the target for this analysis, you would need to buy SFL shares for no more than $7. And this all leads us to the analyst's final conclusion, which is, well, it's about as direct as it gets. SFL Corporation should be seen as an income play, a way to collect that dividend, but not as a true long-term compounder that's going to grow your capital in a big way. The advice? Wait for an industry downturn to get a much better price. So to wrap this all up, let's just lock in the 3 key takeaways from this whole analysis. First, SFL's high dividend is super tempting, but it comes attached to some significant risks from its high debt and the cycles of the industry. Second, the analysis pegs its fair value around $9.70, which is quite a bit below its current market price. And third, for an investor who's targeting a solid 9% long-term return, the price would need to fall all the way to around $7 to really become attractive. Well, I hope this deep dive gave you a really clear, data-driven picture of SFL Corporation. Now, we would love to hear from you. What company is on your radar? Drop a comment below and let us know what stock you want us to break down in our next explainer.